Imagine getting in on a stock right before it took off. Well, imagining it happening is as close as most people will get to this type of situation. Yes, if you had bought Amazon or Google during their initial public offerings and sold those stock shares today, you would be happy with the returns. The problem is that there is no surefire way to predict when and how that will happen again. The good news is that there are ways to invest in the stock market and make money. Today, we are going to talk about the top 10 stock market tips for beginning investors. Number 1. Use stop-loss orders. Putting money into the stock market can be risky, but stop-loss orders can help reduce the chance of losing money. A stop-loss order is an order to sell a security when it drops to a specific price. This way, if the stock price drops far below what the investor paid for it, they know they won't lose any more than they are willing to risk. However, it is important to note that stop-loss orders are not guaranteed. If the market gaps down sharply, your order may not be executed at precisely the price you wanted. Number 2. Use dollar cost averaging. There is a type of investing in which stock is purchased at regular intervals regardless of stock price. Dollar cost averaging is a great way to invest in the stock market because it takes the guesswork out of deciding when to buy stock. It does this by setting up regular investments in set amounts. It takes the emotion out of investing decisions and helps you build a more diversified portfolio while lowering your risk. Number 3. Have realistic expectations. Investors should know that the returns from the stock market are unpredictable and can be volatile. When choosing investments, you should keep long-term goals in mind. When investing in the stock market, investors can make smart choices and reduce risk over time if they are patient, committed, and have realistic goals. Number 4. Do your research. Before investing, it is essential to do your research and understand the risks involved. This research should include a look at the financial statements of the company and a review of the industry in which it works. By understanding the risks involved, you will be less likely to make emotionally driven decisions when the market is volatile. Take time to understand stock market fundamentals like analyzing financial statements, tracking stock prices, and watching for new stock launches. In the stock market, knowledge truly is power. Number 5. Understand your risk tolerance. This refers to how much risk you are willing and able to take on in pursuit of your investment goals. Consider factors such as your age and financial commitments when assessing how comfortable you are when taking on stock market risks. It can be both exciting and stressful. Taking on too much risk can lead to significant losses, while taking on too little risk may result in lower returns over time. Number 6. Stay disciplined. Once you have a plan and have done your research, it is important to stay disciplined and stick to your plan. Without discipline, confidence can quickly melt away as trading decisions are affected by emotion. When the market is down, resist the urge to sell all of your stocks, and when the market is up, resist the urge to buy more stocks than you had initially planned. Number 7. Have a long-term perspective. Most of the time, long-term investors do better than short-term investors over the course of their investments. This is because long-term investors stay invested through the inevitable ups and downs of the stock market. So, investing in the stock market with a long-term view can help make sure you have more success, which can lead to a financially secure future. Number 8. Diversify your portfolio. It is essential to diversify your stock market portfolio to feel financially secure. Diversification includes investing in various stocks from various sectors, industries, and geographical locations. This will make sure that even if one stock doesn't do well, your overall stock performance will still be good because other stocks are doing well. Number 9. Review your portfolio regularly. As a stock market investor, you must keep track of your stock portfolios and review them on a regular basis to keep up with changing stock market conditions. This review could involve selling off some stocks that have risen high past their initial purchase price points, or researching before purchasing more stock in a specific sector or company. Number 10. While we have talked about it several times already, it cannot be stressed enough. Keep emotions in check. Investing in the stock market can be exciting. However, when emotions run wild, it is easy to make impulsive decisions that don't always turn out well. To avoid severe losses, research and educate yourself on stock market trends, evaluate your risk tolerance levels carefully, and take a long-term view of stock market investing. Remember, fear and greed are two emotions that can lead to poor investment decisions. If you feel like you are about to make an emotional decision, it may be best to take a step back and wait until you have calmed down before making any decisions. Investing in the stock market can be intimidating for beginning stock market investors, but it doesn't have to be. All that's needed is knowledge, dedication, and a sound investment strategy. If you want to learn more about anything covered in today's video, please let us know by adding your comments in the section below. We hope to have put you in a good money mood.